Hi, guys, and welcome to the 21st episode of the weekly trading wrap up, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we're starting off with a picture of the S&P 500. Uh, it's been a crazy week. As you can see here, it's tough to see, so let me fix this a bit better so that you guys can see. I have all these levels here, but let's just go here. Okay. The arrow here denotes Monday. This is Monday after a devastating fall last week on Thursday and Friday. This day right here is Liberation Day of last week. So here we have Monday, Tuesday, a crazy Wednesday, which is like up 10%. Thursday and Friday, which is today, the day that I am recording this episode. So, like a rough estimate, like it went all the way down to this key level of 480 on the S&P 500. If you see, this was the previous high that we broke out of last year. So, after a crazy drop, okay, it hit 480, went as high as what is it? Let's say 550, probably shy of that. So what is that? That's like from low of the week to high of the week. Must have been like a 14, 15% move. Unheard of. Look at the volatility. Look at the volume. This was huge volume. Look at Friday's volume after on last week. Friday's volume, the 4th of April, huge compared to everything else. Dwarfed by this week's volume. Crazy. Okay, so let's get to the technical picture. You can see this right now. I'm gonna like shorten it a bit so that we can see everything without this interrupting us. Okay, so let's put on some moving averages. This dark blue is the 200. The 50-day is the red, and like we said last week, we're probably gonna have a death cross, which is the 50 crossing under the 200-day. Okay, that's bad. Okay, that's signifying that we should be in bearish mode. Anything under the 200-day means bearish mode. So again, the technicals are bearish. Okay, and this death cross doesn't mean like we can have a situation like forget what's going on in the world, but if this were to come back quickly, this death cross will then soon turn into a golden cross if we continue to go higher. Okay, so this is a lagging indicator, but people look at it, so we should look at it too. What really matters is that we're trading under the 200, and we have a very negative macroeconomic outlook. So the technical picture, despite the fact that it's extremely volatile this week, okay, and it looks like it might be holding a bit, it's still very, very bearish. Okay, and if we look at the technical indicators like the fear and greed index, on Friday we're still at 13, but this whole week we were at 6, 7, 8, 9. Even when it ripped, I think we went to like 20, 23 on the extreme fear when we had this monster Wednesday. Okay, I think at this point we were at 23, but still, we were still at extreme fear. We never went to fear. So despite this craziness, we are still in extreme fear. And looking at the AAII investor sentiment, this is like, I don't know, the 6th, 7th week of extremely negative bearish sentiment. Okay, this is not just sentiment. We also have the positioning is extremely bearish. We have the put call ratio at extreme highs, and everybody is not only bearish but positioned bearish as well. Okay, so this is why, like, just based on the technicals and this positioning, I think we continue this bounce. Okay, we are still consolidating the weirdness that happened after Liberation Day, which was here. So very, very strange technical picture. This, I don't know, but this is all brought about by one man, Donald Trump, and his campaign to onshore manufacturing and to help the common worker, the common U.S. worker, regain his job. That is his goal. Okay, whether he achieves that remains to be seen. We'll see. But this is what caused this crazy, crazy type of move. Okay, and the fact that we're still very bearish, and we just keep getting more and more negative news, okay? But just the technical picture here is bearish, but because of the sentiment that is still very bearish, I think we bounce back. We bounce back in the short term. After that, I don't know, we have to reevaluate, but the technical picture, which I will come back to later on, is still bearish, okay? So now let's move on to the macro section. We always talk about macro second, the major macro events that are happening. Well, really, the market is driven by what Trump is doing, but technically, I guess you can call that a macro event because tariffs are geopolitical and they are the most important macro event going on right now. But I mean, apart from that, I'm talking about the regular macro things that we look at. And for the entire week, there was really nothing except Thursday and Friday. There were big inflation numbers coming out, okay? So the first thing that came out on Thursday was the CPI, the normal inflation figure, okay? And the CPI came out at 0.1%, tanking, okay? Everybody's expecting hot inflation, tariffs are inflationary, but what's happening, okay? United States core inflation rate came out at 0.1%. Okay, I think they were expecting, what were they expecting? Let me check here. They're expecting 0.3%. This is a huge deflationary or disinflationary move, okay? I'm telling you, we are going into deflationary pressures. There's no inflation. I shouldn't say there's no inflation. Inflation will be coming down, okay? That's what happened on Thursday. And the other inflation figure was the PPI that came in. This is the producer price inflation month over month, came in at minus 0.4%. They're expecting plus 0.2. They're expecting a bit higher. They're expecting plus 0.2 here. And they got everybody was thinking that producer prices will be increasing. Okay, no, they're decreasing, okay, for various reasons. So the two main inflation metrics that came out were very disinflationary, okay, going against what everybody thinks would have happened, which everybody thinks is going to be an inflationary print, okay? More inflation than ever. Everybody's freaking out at Trump's tariffs and their inflation. No, we're not going to have inflation. In fact, these are the numbers that really piss me off, okay? Like the UMich, University of Michigan, inflation expectations. This is when they poll people, and they think that last month they thought it was 5%. This one they think it's going to be 6.7% inflation in April 2025. Okay, excuse me. So they think inflation is going to come in at 6.7% in April, and they think that it's going to be the 5-year inflation expectation increased to 4.4%. So they think 5-year inflation will average 4.4% every year for the next 5 years. This is crazy. Literally crazy, because if you look at the break-evens, which is an actual figure, the 5-year break-even inflation rate, it's down, okay? And the market expects, the real market, actual market participants expect it to be 2.32%. That's the 5-year inflation rate, okay? Not 4.4%, which is extremely, extremely crazy, stupid. I don't put any stock in the UMich inflation expectations, and neither should the market, and neither should you. Okay, this is just people's fear of what they think might happen given what they perceive Trump's tariffs will do in the future. See, this is all based on nebulous if, could, maybe, this is what we think, this is what we're taught in school, that tariffs might be inflationary. Maybe they're not. Maybe they're deflationary. Maybe they cause a recession, which is deflationary. Who knows? But this is the narrative that is built into this UMich inflation expectation, okay? So we can just dump that, forget about it, okay? Another piece of macro that came out is the initial claims. Came out at 223,000. As long as it's within the range, nothing to see here. So no unemployment claims are being made. The economy is still doing okay as we speak, okay? And the other thing that we should look at is the UMich consumer sentiment. That's different. And the consumer sentiment tanked to 50, okay? And if you can see, if we go back further, you can see that 50 is an extremely low number. Let's bring it up here. Consumer sentiment. sentiment. Fred database. Okay, as you can see here, this is the Federal Reserve database on consumer sentiment on the University of Michigan consumer sentiment. And, well, they don't have the final print. It's down to 50. Look, this is like a print of, what is it, 50? Let's see. What's that low here? 50. Okay, let's go back to the max. Okay, that line is 50. So we're already there right now. One of the lowest figures of all time, going back to 75? What is it? 1978. That's how much fear there is in the market over Trump's tariffs and him going to war against everybody. 50. People are really scared. Okay, but that could be a trough. Look, whenever it gets that low, it usually rebounds after. It's really very, very exaggerated. Okay, who knows? Okay? But I'm just telling you that the consumer is really, really scared, and I think that's what's driving the University of Michigan expectation that 5-year inflation is 4.4%, or what is it? No, that's a consumer sentiment. Or that the 1-year inflation expectations are in 2025 will be 6.2%. Okay. That's crazy. That's just nuts. I can't get over it. Okay, so that's the end of the macro. Okay, so let's go on to the section where I talk about other interesting stuff. Okay, yields. Yep, yields. Okay, what happened? Monday, Tuesday, yields were going down because inflation was going down, right? But we just saw that the break-even inflation was going down. So what is driving this massive move? This is 1 week. The U.S. 10-year, I'm looking at the U.S. 10-year yield, by the way, the benchmark yield. It went from 3.9 to like 4.5, 0.6% move in bonds in a week. Crazy. They are dumping bonds. Okay. This is part of what I like to call the New World Order, which is coming. Okay. We have something going on now that is very, very, very weird. Okay, I call it the New World Order because I think Trump right now has in effect ushered in a new world order with his move on interest rates. Okay, and you have very weird stuff going on. You have SPY that we saw the market going down literally 15% in a week, bouncing back and then settling around here. So you have the market going down, but you have the US 10-year yield going up. This should be going down in normal times. Okay? We also have, because it's a flight to safety, people sell stocks, stock market goes down, we all know that, and then they put the money into bonds because it's safe. But now they're not putting the money into bonds. See, because bonds, let's look at the TLT, it's the mirror image of that. Bonds have been going down this whole week. The TLT here, this is the 20-year bond, Treasury bond ETF, down. Okay, they're dumping bonds. Now people say China's dumping, maybe that's part of it, but the fact is that people are not flying to safety and putting it in bonds, and they are certainly not putting it into, we haven't seen this in a while, the Dixie. This is the US dollar index. Okay, let's go back. Look at it. Broke support. This long-term support broke it. Okay, in like this Thursday, Friday, but this whole week it's around here. The week starts around here, Monday. Let's get rid of these moving averages. We don't need them anymore, so you can see it more clearly. Look, it broke this technical level, and Dixie is below 100. It was literally like, I don't know, a month ago. Let's go back to the beginning of the year, January. It was like at 109. Just like 10%, let's say. 10% in like 4 months or almost 3 to 4 months is a huge move for a currency. Okay, so even the dollar is in a flight to safety. People are dumping dollars in this new world order. Very, very strange. You don't see that. Okay, so you have risk-off assets acting as risk-on assets. They're being dumped. The dollar and bonds are being dumped. Whereas things that you would think are risky, like Bitcoin, up on the month. Where is it? This is Monday, right there. This is Monday. So literally, Bitcoin is up this week, okay, and holding up much better than the market, okay, and not as volatile. Look at the volatility of Bitcoin compared to the volatility of SPY this past week. Can't see it, but look at this crazy volatility. Up and down, from low to high is a 15% change. That didn't happen in Bitcoin. What, now SPY is the new Bitcoin? Is that what we're going to say? So we have Bitcoin up, especially on Friday. We have dollar down where it should be up. We have TLT bonds down where they should be up. And we have gold up massively on the week. Massively. We'll get into this later, but so far let's go back to talk about this geopolitical thing that is going on, especially with the US 10-year, okay? So this is my take, okay? I don't know if this is exactly what's happening, but my view on why they're dumping treasuries, apart from maybe China, okay, China's helping, but this should be more fundamental. They're dumping treasuries because, in my view, if we have a trade war and the global economic order is now switching whereas the States now isn't going to impose tariffs on countries that have tariffs on it, okay, this will slow global trade. Okay, and if this slows global trade, it will affect how foreign countries invest in treasuries. Why? Okay, there's a little bit of a long explanation. I'll try to get to it a bit as quick as I can. So the US is the world reserve currency. Okay, that means it's literally acting as if it was gold itself. Okay, the US dollar is like what gold used to be under a gold standard. Every country has to use it. So the US, being the world reserve currency, must print dollars and export them so that everybody else has them, because that's how world trade is done. That's the world currency now. So you, as the country that is the world reserve currency, must export your dollars to everybody else so they can buy copper, commodities, and other stuff that is priced in US dollars, because you're acting like gold now. Okay? In order to do that, in order to export, you as a country have to be a net importer of foreign goods, because when you buy foreign goods, you get the foreign goods and you give those foreign countries the dollars that they need. Okay, that's how the euro dollar market started. So there's a bunch of dollars outside the US called the euro dollar market that is much bigger and plays by its own rules. Okay, and the reason that is the case is because the US has been the world reserve currency since 1971, when we went off the gold standard, and that's why people need foreigners need US dollars. Okay, and in order for a country to do that, one, it must be a net importer. Two, it must have very well functioning capital markets, bond markets specifically. Why? Okay, you can't have any restrictions on your bond market. You must be able to allow foreign countries to invest in your bonds. Why? Because when they sell their products to you, you get their product, you give them dollars. What are they going to do? Just have the dollar sit there? No, they want to either, it has to earn interest. It has to be invested somewhere, okay, somewhere safe, because you want to hold that as a safe asset. You don't want to. It's like a company who holds cash. That needs it for their operations. They don't just invest in something risky. They put it in marketable securities or short-term, a bank account, short-term deposits. Okay. Same thing with countries. They need to invest their excess dollars into something that will, earn them a return, a safe return. So they do that by investing in treasuries, U.S. treasuries. And that's why there's always a bid on the U.S. treasury market, because foreigners take their excess dollars that they have from selling their products and to the U.S. market, and they put it into treasuries, safe securities. That's the game. That's why treasuries always have a bid. That's why there's a huge foreign demand for treasuries. Okay. And the other thing that if you want to be the world reserve currency is that not only do you have to be a net importer, you have to be have free and very liquid bond markets. You also have to have no capital controls on your currency. People have to be able to buy and sell your dollar, transact it very, very freely because it's necessary for world trade. Okay, and the U.S. has all that. So you keep hearing people that say that the U.S. is going to lose reserve currency status, but how is that possible? Like, being a reserve currency is almost like a poison pill. Not exactly, but you have to abide by those rules if you're going to be the world reserve currency. You have to be a net importer, you have to have free and open capital markets, and you have to have no capital controls on your currency. Do you think China does that? There's no way the Chinese yuan will ever be the world reserve currency. One, because China cannot be a net importer right now. They are a net exporter. Okay, like almost every other country in the world, they export to the U.S. Okay, they don't have the domestic market strength that the U.S. does in order to, or the consumer strength that the U.S. consumer has, in order to turn themselves into a net importer. Impossible. That's one. Two, no other country will do that either. Russia, India, none of them. Okay, so they have to find other ways. Okay. Two is that they don't have a well-functioning debt market. Okay, it's very controlled. Foreigners can't enter it. Okay, and it's like there's a moat around it. There's a high 10-foot wall around the Chinese bond market. Try buying a Chinese bond. Impossible. So how can foreigners who transact business with a yuan invest it in a yuan bond? It doesn't exist. It's hard to do. They can't. Okay. And second, China has massive currency manipulation and control over the currency. So it's not a free-floating currency. It's controlled. So they don't have the three elements, the top three elements. There are more. I don't want to get into it, more than I already have. But they cannot be the world reserve currency. Okay. So there are other ways. They have to use something else. The BRICS countries, no BRICS country can be the world reserve currency. They have to use another way, and that is gold. Okay. But this is why, long story short, is that I believe that here the U.S. 10-year yield is climbing. They are selling bonds because with this new world order, with Trump putting on tariffs on other countries, it makes it more difficult for the U.S. to be a net importer. They will import less. Okay? They will force other countries to consume their own products more. And if you import less, that means you will buy less products from somebody else, which means you will give less dollars to those people. And those people that have less dollars are going to buy less treasuries going forward. They're not going to park as many dollars in treasuries as they had in the previous world order, where the U.S. had no barriers and everybody else had trade barriers, and everybody else had barriers on them and manipulated the currency against them. Okay, so I think that plays a big role in people dumping treasuries as a safe haven, because there's no longer going to be as much of a demand or a bid under treasuries as it was before. Okay, and that's why I think it's the same with the Dixie. The dollar is tanking because there's going to be less dollars demanded, because less foreign goods are going to be sold into the U.S. market. That's my view on that. So this is why there is a. Oh, and by the way, we go back to the U.S. 10-year. Okay. What was I going to say? Just skip me. The U.S. 10-year, it's up here, and it's not because the bond vigilantes and they think inflation is coming, because we just saw that the break-evens inflation is going down. Okay, let's go again to the break-evens. The 5-year inflation, down. Okay, from 2.6 to 2.3. That's a big drop in inflation, okay, in a quick amount of time. Okay, so we know that the U.S. 10-year is not rising because of inflation expectations. Okay, it probably rising because less of a safe haven asset, rejiggering of the new world order, rejiggering of the economy, which is the new world order, less demand for them going forward. Okay, and yes, maybe China is dumping a bit, but that's probably short term. They don't have enough treasuries to dump that are really affected, because we said before that a very unique thing that happened, that everybody was expecting would not happen, is that we had the U.S. 10-year and U.S. 30-year bond auctions were wildly successful. Okay, they were stop-throughs. The people were demanding more 10-year and 30-year U.S. paper than before. Why? Here it looks like they're selling them. But the reason is trade is just one aspect of the demand for the U.S. dollar. The other thing that is in demand for the U.S. dollar is that It is the world reserve currency. They still require it. Foreigners still require it because foreigners have issued in the past a lot of US dollar denominated debt. Okay? And they need dollars to honor those debts. Okay? Because they couldn't issue in their own currency. There wasn't that much of demand, but they had to issue in US dollars. So there is a baseline US dollar demand, foreign demand, for the US dollar, okay, itself. So even though it looks like the dollar's going, you have competing forces, okay? You have competing forces of, I need this dollar as a foreigner because I need to pay my US dollar debt, but I'm not going to sell as much goods in the future, so I might not need treasuries. So you have all these competing forces happening, and this is the result. This is why, in my opinion, of course, we have such massive volatility on the SPY in just 1 week. In just 1 week, Trump changed everything. So you have all this, and people are just scrambling. What's going to happen? Is it going to be good? Is it going to be bad? It's a give and take, back and forth. Treasuries are being dumped because of, is it going to be good? Is it going to be bad? We have to readjust our thoughts on the new world order, okay? And this is what, hence the volatility. But make no mistake about it, this is a new era we're in, and it's the very beginning, okay? And one of the main beneficiaries of this is my next favorite subject, gold. Gold. Look at this, past 3 days. Gold is up massively. Okay, from 29.80 to 32.36. Huge move in gold. Okay, why? Why is gold all of a sudden? I think gold right now is the perfect investment. The perfect investment. Nothing could go wrong. I know I should never say that. But it's literally a geopolitical perfect storm for gold. Okay? Like before, I just mentioned why, because of the New World Order, Treasury yields are climbing. So bonds are not a safe haven anymore for investors, U.S. investors. The dollar is not a safe haven anymore for U.S. investors. So now I think you have U.S. investors buying gold. Okay, whereas before they were net sellers. Okay, so now not only do you have Asian buyers, like China is still buying gold. The reason gold went up in, all the way back after it broke out the 2000 level, the reason from 2000 all the way to here wasn't Trump. Okay, Trump is this. The reason, this whole reason from 2000 to 3000, 50% increase, was because central banks were buying it, foreign central banks. The BRICS currencies, like we mentioned before, they themselves, the BRICS countries, they themselves cannot be the world reserve currency. So but in order to battle against the dollar in the US, they need something that the world trusts just as much, if not more, and that's gold. So the world's foreign central banks, BRICS, the big ones outside of the Western ones, outside of the Fed, the BOJ, the European Bank, Central Bank, etc., they are accumulating gold because that is going to be their reserve currency asset. The alternative to the U.S., okay, is gold. And that's still going to stay, even if we didn't have Trump going to war. Okay, so this is why it's a perfect storm. There was already a massive bid under gold, and now you have an even massiver, an even more massive, I should say, bid because of Trump's New World Order. Because now we saw that bonds and the dollar are not reserve assets. Are not flights to safety. So now you have gold acting as a flight to safety and a risk-on asset because other countries have demand for it, namely the BRICS. Okay, so you have a war going on that is massively benefiting gold. Either way you look at it, even if Trump disappeared tomorrow, gold would catch a bid. And all of this entry into gold started because of the Russian invasion of Ukraine and what the U.S. did to Russian assets, Russian dollar assets, because they froze their assets. So all the BRICS countries saw what the U.S. did, and they've been accumulating gold ever since. I mean, China has been accumulating gold since 2010. They want to have as many reserves as the States, which is very difficult. They have they say officially 2,000, they might have 4,000 tons, but the U.S. has 8,000 tons. Okay, so they need to acquire as much gold as they can to match the U.S., which is very, very difficult. Look, in 15 years, they've only been able to accumulate, let's say, 2,000 tons, which is, it's very hard to do. and they've been on, on rocket fuel trying to do it. Okay, but now that the New World Order, the order is in effect, now you're going to have Western demand on top of Eastern demand in gold. Okay, so that's why I think the best place to be in is gold, and by proxy, I think gold miners. Look, gold miners are ripping. This is the GDX. Okay, the GDX in 1 week went from 40 to 49. Let's say let's say 50. So 10 points, 25% return. 1 week. AEM, my favorite, that too went 24% up in a week. That's Monday right here. That's Monday right here. 24% up. And this is a major. Okay. So I think because of the change in the New World Order, that gold is going to be the asset of the decade. Okay? All things being equal. Because if Trump comes tomorrow and changes everything, I don't think it changes much because, like we said, there's huge demand, and he's already shown that he's willing to go to war with all these countries. Nobody's going to trust him anymore. We don't know when the next hammer is going to drop. So that's why I think no matter what, and I don't want to jinx it, but no matter what, I think gold will catch a bid, at least for years. So that's it for this crazy week. Let's recap. The market is still adjusting. It doesn't know exactly yet what's happening. I think personally, because of these conditions that we saw, the extreme fear, sentiment, and other indicators that are, like, a lot of people are into puts and are short. I think we bounce again. I think we're going to bounce again. After that, I don't know. It depends on what Trump does. It depends what happens. But generally speaking, if we stay below the 200-day, it's starting to downward slope, which is very dangerous. If we stay below that, which I think we might, maybe go a bit higher, we could even go even lower in the weeks to come. And if we have a recession, it does cause a recession, we will go lower. We will go below the 480. But I don't know. Trump could be very, very crazy. He could do some crazy stuff that's very bullish and could take this market up to 6 new highs before rolling over again. I don't know. Okay, because this is a new world order. You have to adjust. You can't play by the old rules. The 60-40 portfolio is dead. Okay? Long live gold. Later, guys.